Good morning and welcome. So as a start, we're going to Edgar and we're going to calculate a fixed asset percentage. In the chat, I put the Google Doc that I'd like you to add to. Pick a company of your choice. Again, please don't use the hard copy annual reports you have. Please use Edgar. Do the search on Edgar. Google search is easy to find under company. You probably want to use Classic View. And with that, I'm going to have you try to calculate the fixed asset percentage. On Friday, we determined Costco, about 50% of their balance sheet, almost 50%, is fixed assets. So when they're up soliciting debt, selling stock, a lot of that's to finance the expansion, to finance their buildings that they're buying and building out, the equipment they're putting in them, the warehouses and storage of stuff. So they've got a lot of real estate to manage. And that's most of what their fixed assets seems to be made up of. Some manufacturers might be more oriented towards production equipment, machinery, manufacturing. Some places like hotels might have a lot of hotels.
So would the fixed assets just be like the property?
Total property, plant, and equipment.
Okay,
PP&E.
property and plant equipment. So basically everything that isn't a current asset.
Except for they might have some intangibles that are also not included.
Okay, so then remove those, but okay, gotcha.
Yeah. Property, plant, and equipment. So just the tangibles, the thing you can touch, the cars you can drive, the buildings you can reside in and work in. And then you might look at some fast food restaurants and say, wait a minute, they don't have as many fixed assets as I thought they would. And a lot of them are more of a franchise model. They may have a couple of company-owned stores, but it depends on the model. Like McDonald's has a lot of company-owned stores, but they also have a lot of franchises. Where Wendy's is trying to get to almost 100% franchise model, not owning any stores except for test marketing a few things. So it really depends on the operation as well. A lot of hotels, the brand name is a franchise. The rights to that name, the rights to the reservation systems. But a lot of folks don't own the hotels. Other companies actually own the real estate and own the hotels. And they just lease the name. They buy the rights to use that name for a 10-year spell or whatever time period. Possible options to renew. I had a franchise at one point. 10-year franchise, option to renew. So those are things you have available. So go ahead, pop on the spreadsheet, and please add accordingly. And you do need to have a U.S. company to find it on Edgar, publicly traded U.S. company. Folks like Kohler that makes bathroom and sink fixtures are not publicly traded. Folks like Johnson, SC Johnson, which does Johnson Wax, and Pledge, and Saran Wrap, they're not publicly traded. But folks like Sunoco in Hartsville is a publicly traded company, actually a pretty big publicly traded company. Folks in Charlotte like Bank of America, Duke Energy, those are publicly traded.
Quick question. So I'm looking at all like the assets, and there's other assets, non-current, deferred income tax assets, net, equity and net assets of affiliated companies, property, investment and operating leases, and then non-current portion. I would just do the property, right?
Just looking at the property, correct.
Okay, that's what I thought, because I don't see really any other.
And technically, you might start saying, well, aren't the leases things that they are leased equipment? And we'll talk about a little bit more about that, because GAAP changed about 2 years ago on recording leased equipment. And it really affected how the balance sheet and income statements presentations come out and expenses associated. You used to be able to lease things and not have to show them on the income statement. We'll call it operating leases, but now you got to show the asset, you got to show the equipment, leasehold improvements, everything there. So PP&E, property, plant, and equipment is what we're looking for. Okay, so I'm looking at GameStop right now. You got 37%, over a third of the assets are fixed assets. Now, GameStop probably does not own their own shops in terms of the real estate. They probably are in a strip mall and they lease space, but they've got their own buildings. They've got their own fixtures. They've got their own equipment, and they have their own tools of the trade. We saw on Ford at 14%. Fixed assets, but they have a lot of other things going on. I see Tesla is on the list, but you don't have a calculation yet. But we're looking to get the calculations going so we can evaluate accordingly. Please update. That's my attendance question for the day. It's coming up with a calculation.
Dr. Scott,
Yes.
I guess I'm having like a brain fart right now. I kind of can't remember exactly where we go on Edgar. Could you kind of like show us again, or
Sure.
maybe say what I click on Edgar?
I appreciate the question. Let's do a walkthrough. Okay, so I'm going to share the screen. I'm going to go over to, whoops, let me see what I can do. We're going to go over to Edgar. I'll do a search for Edgar. We'll start here. So we'll do a Google search from scratch. So sec.gov/Edgar, that's the right place. And search and access, or just the SEC site. And company or fund name down here, search by, or company filings, will go to the same place. I'm going to hit company filings. And then name or ticker symbol. And let's say I wanted to take a look. I really can't do Honda. I can't do Lexus or Toyota. Those are Japanese companies, but I can do American companies. So say I wanted to go to General Motors. Okay, and there it is, GM. So I'm going to click on General Motors. And this is the project you're going to have to work on. You're going to have to go here too. Now, you can either go to the 10K here where the plus sign is, but I like going to the classic version, because a classic version is the old way of getting the Excel spreadsheets really quickly. So I'm going to click on classic version. And then the filing type, annual report, what did we say it was? 10K. And then two options. I can go to interactive data, and I either can go directly to the financial statements, or I can view an Excel document. I'm going to go to the financial statements just real quickly right now. I'm going to go to financial statements, statement of income, statement of comprehensive income, balance sheet parenthetical, cash flow, statement of equity. Let's go into income statement just to see how they're doing. So they've been declining for 3 years. That's our trend analysis, horizontal analysis, from $133 billion down to $108 billion. And net sales, 147 billion down to 122. Profitability, net income, actually not so bad. They're pretty steady state, 6.3 billion this past year, 6.7 previous, and 8 billion. So they are still a downward trend. But that's not where I find my fixed assets. What statement do I have to go for fixed assets? There we go, balance sheet. There's my current assets, non-current assets, property, goodwill, equipment, total assets. Okay. So if I go back and I'm going to go in and I'm going to go through and say, okay, let's, just like Ford, we had a lot of things here. And this is actually a good example that can help confuse us. But I'm going to go through and I'm actually going to go view Excel documents. I'm going to go back to this balance sheet, but I'm going to go into Excel. So if I go to Excel, I say, all right, I'm going to be looking at, let's see, Excel is going to load up. And hopefully you should be all able to see my screen. On the bottom, I've got these tabs. I've got consolidated income statement. Oh, that was the first place I went to. Statement of comprehensive income. I don't want that one. That starts with net income. Consolidated balance sheet. And I'm going to insert a column here just for kicks. Oops, I got to enable editing first. So I'll enable my editing. This is again what you're going to do. This is what you needed to do for the last discussion question on the homework. And this is what you're gonna have to do for your projects, your annual report projects. We're gonna be using Edgar, not the hard copy printout you have. So I'm gonna go for non-current assets. Now I see my total assets here is 235,194. And I'm gonna go down here and I'm gonna go and say, let's see, I'm gonna do total non-current assets. I don't want necessarily total non-current assets, but I'm gonna have equals my property of 37, that's my net property. And I'm gonna add to that my equipment and operating leases. Okay. So I know, David, when we discussed it before, I said, yeah, don't worry about the leases right now. You got a ballpark. But leases of operating leases, equipment, that would be PP&E. Okay. Deferred income taxes, no. Goodwill and intangibles, no. So there's my total of $77 billion in fixed assets out of $154 billion. And so I'm going to say equals that slash that. And I'm going to come up, I'll make that a percentage column because that's not going to help me reading as a one, round up. So that's about 50%. And David, actually, if you want to go ahead and include leased equipment, that may not be a bad idea. I know I said you didn't have to, but I'm saying, man, probably not a bad idea. But we're 50% of GM's equipment, fixed assets, property, plant, and equipment, net of accumulated depreciation. That total is 50% of the balance sheet. So now I'll go back to my spreadsheet. What's that? Oops, that was on here. And I'll go put in GM. And I'll put in Dr. Scott, because that's who I am. And I'm going to put 50%. Hopefully that walks you through, helps you answer anybody else who's having trouble finding Edgar, accessing Edgar. There is a video on the recorded already on Edgar up in on the course itself. So hopefully that gives you a chance to go through, make adjustments, make corrections, and do the calculation. So our goal here is to see, and as I said, Friday we saw that Costco, 50% of their assets is fixed assets. They got to finance those. They got to take on debt or sell stock. Same thing for GM, 50% of their assets are fixed assets, either under lease or having purchased. And a lease is just almost like just financing arrangement, almost like a purchase. So all of you should be able to go in there. Again, this is the attendance question for the day. This is your input. And this is seeing where they compare. I'm curious how Tesla compares to Ford to GM, as a matter of fact. So Antonio, looking forward to your calculation.
Yeah, okay. So I'm dividing the property, plant, and equipment net, right, by current assets, correct?
By current or total?
Total, correct?
Total, it better be total. You're right, because current is just the current assets like cash and receivables. You want all the assets. What percent of my balance sheet is fixed assets is the question. We already did this for receivables. Okay. So when we go in, we went ahead and said, okay, when we did our tallies, we said inventory as a percent of total assets. You already did that. We did accounts receivable as a percent of total assets. So right now I'm asking PP&E as a percent of total assets. So how equipment intensive are they? We looked at folks and we saw some of the retailers had 50% inventory as a percentage of total. Again, not of current assets. Be careful because it totals current assets very nicely. It totals current liabilities very nicely for you. But that's not what we need or what we want. We want total assets, which is the same as total liabilities which happens to equal total liabilities plus total equity. Again, you know that. Same as total assets. Okay. Anybody else challenged trying to figure this out? And again, that classic view on Edgar, it just changed in the past couple of weeks. So I did create a new video, but that's where it's nice that you can get the spreadsheets, all the numbers already put in cells for you without having to transpose them or transcribe them from the 10K over. Okay. And for those of you that really just need to read the 10K, which you will have to do as well, I'm going to go back here. Go backwards a little bit. And when I was on General Motors, before I hit classic version, I could hit 10K here, get the latest 10K annual from February 10th. And this is the actual document that you will read. Cover to cover for the company you're doing for your annual report project. And if you look down here, somewhere around, let's see, what do we have? Our notes, our items. Item 6, financial data.
We can only see the whiteboard screen.
Oh, I'm sorry. Thank you for pointing that out. I'm going to go ahead and share my screen elsewhere. Okay. So what we did before on Edgar, I took you to classic version, but instead of classic version, I have you just going straight to the 10K so you can read it cover to cover. There's 10Ks and 10 Qs. Quarterly, there's 3 Qs, 3 quarterlies, and the annual. I'm going to have you go to the 10K, click on it. You load the form. You'll have the full 10K at your disposal to read through. Filing information. And you'll see that we got these items. 1, business. 1A, risk factors. It's kind of interesting to really read the risk. They say, you know what? We're at the risk of the world. Could be a pandemic. Could be a government taking over our assets or nationalizing our assets. You go down here and you say financial statement, item 8, and the notes. So they're all down here. You go to the 10K, you start reading, and you go down to item 8, and then you go note 1, note 2, note 3, note 4. They're all there. This is all the information on the 10K. So yes, you will be reading it cover to cover to get a feel for the company. And I'll tell you the power. Think about it. You're applying for a job. Maybe it's not for Tesla or GM or Ford, but maybe it's another auto producer or a startup or something. You want to look and see, well, what are the terminology that GM uses? What does GM think their risks are? What are the performance at GM? How profitable are they? Oh, their trends are going down in sales. That's not good. The trends are going down in profits. That's not good. So if you are an interview and ask the question, I noticed GM sales are declining over the past 3 years. How about yours? That's a pretty intelligent question when you're interviewing and somebody says, how do you know the sales of GM have been declining? You must have done some research. You must have done some homework. So that's pretty powerful. Lots of information on the 10K. Even if it's a hobby, GameStop. Even if you're looking at a company and saying Electronic Arts, hey, I'm into gaming. Cool. I want to know about this, what they're doing. I want to know if they're going to be around, what they got new stuff coming up on the pike. And those are opportunities for you to learn the insides of some of these companies. Is that making sense? So let's go back to our spreadsheet. There we go, coming our way. We got Wendy's, 30, about
Dr.
a third.
Scott,
Yes.
can I have some help with the percentage? Because I don't think I'm doing it right, because I'm not getting the right.
I'll tell you what, I'm going to let you share your screen.
That's the thing. I can't share my screen.
You can't share? Okay.
No,
What
sir, 'cause
company?
Johnson & Johnson.
Okay, Johnson & Johnson. Now you're looking at the annual report.
Yes, sir.
You're looking at the balance sheet.
Yes, sir.
And what numbers do you see on the balance sheet do you think that would be useful?
The total assets and the property, plant, and equipment net.
Those are the two numbers you need. Which one goes to the numerator?
The property, plant, and equipment.
You got a winner. Divide out the two. What do you get for percentage?
Um,
I'm going to go Johnson Johnson. I'm going to go to the classic version. Go to the 10K, and actually it's easier if I type 10K, it'll filter it. But here's my 10K. What do you got for percentage?
I'm doing.
And I'll go to the financial statements here for the balance sheet. I'm not going to view the Excel document.
It keeps saying like it's not the right formula.
Well, look on the screen and tell me what two numbers you're working with.
I'm working with 18,766.
Right, which is actually
And-
18,766,000,000, but okay.
Yes, sir. Sorry.
That's okay.
And then the total assets, the 174,894.
And so what's the formula to calculate PP&E as a percentage of total assets? What goes to the numerator?
The property, plant, and equipment.
Yep, 18,766 in the numerator. What goes to the denominator?
The 174,894.
You got a winner, and you should be about 11-12%. It'll come out as a decimal, 0.1 something. What do you get when you put it in the calculator?
I get. Sorry, am I doing this on my laptop?
That's okay. I'm going to view Excel document because again, that's the easiest thing to do.
Yes, sir.
And I'm going to enable editing. And I'm going to take my consolidated balance sheet. What do you get for number? Have you got it yet?
0.107.
Okay, so what percentage is that?
11%.
Yep, or 10.7%. We'll go with one decimal. I
Okay.
like that idea. Okay. So I'll go ahead and I'll do it right here too. I'll do the same thing. I'm going to take my PP&E. Let's see, I'm going to put it right here. So equals, that's why I like a spreadsheet. Property, plant, and equipment slash that. And bingo. That's the number you got, 10.7% or 0.107299. All right. So put the decimal over 10.7%, you're in business. So you can do this, right?
Yes, sir. Thank you.
Oh, no, you're doing fine. You got it. Got a winner. Okay. Other comments, questions? Let's take another look. See how everybody's doing. Again, we're figuring out as a percentage what we're doing here. Okay. So Amazon, a third, similar to Wendy's. 33% a third, 33.3, but that's 35. Ford Motor, 24%. Tesla, 24%. GM, 50%. J&J, 11%. And Snap-on, 12.5%. So a lot of these companies have a bunch of inventory. A lot of these companies have a bunch of cash or receivables. They may have a bunch of intangibles. They can't have more than 100%, by the way, typically. They're not going to have negative assets. Somebody told me in the last class, but my assets are zero. I don't think so. We corrected that. But look at some of these other companies. McDonald's, 47%. Target, 52%. Okay. Chipotle, 28.6, 29%. Walmart, 36%. Netflix, 28%. Oakley, 28%. So fixed assets is a pretty substantial portion of stuff. So I wanted to bring that out to your attention, make you aware. Why we're talking about this is because it's a big number. And again, you either finance it with debt or finance it with equity. And equity could include from profits generated, retained earnings. Okay. All right. I've got one more announcement of things you can get involved with if you like. I'll share the screen. I'm making, excuse me, I'm presenting this week in two venues. One is with the Philadelphia Great Careers Group. I'm doing a LinkedIn workshop from 9 to 11. It's actually an hour and a quarter of my time. I don't get any money out of it, but there is a $5 non-member fee. But actually, as a member, it's like $50 a year. They do some pretty cool career stuff. You don't have to do this. It's not obligated, but I'm going to throw this into the chat. If you're interested, tomorrow from 9 to 11, I'm presenting on LinkedIn. It's developing a top 5% profile on LinkedIn. So if you're curious, if you're interested, you're welcome to participate. And I'll make sure that the chat has, where did my chat go? Chat homepage should be there. I'll just, pop in the chat. Okay. So if you're curious, if you're interested, by all means, you're welcome to participate. Again, nothing required, no obligation. This one's free on Wednesday night, something called the Networking Expo, another business venture I'm involved with. We've got something called Dexter Virtual Expert Directory for entrepreneurs, small business folks, solopreneurs. I'm going to put this in the chat too if you're interested. This is a freebie. And as far as if you're curious and want to participate, there's information in the chat there too. And that's 7 to 8:30 in the evening, Wednesday evening. Just to give you a flavor for some different stuff. There are about almost 20 networking groups that'll be presenting. They'll have breakout rooms. I'll have a breakout room for our offering. But if you're curious and want to explore and have some time, they're both good for extra credit if you want it. Again, I hate to make you pay $5, but it's not something I can defer. Although I'll probably record the presentation. If you want the presentation later on, I can share it with you as well. Save the $5 too. But if you're interested, just want to make sure that you're aware of those options. And I'm going to share the screen again just to show you what those two things are. And some seminars, webinars. There are so many free seminars and webinars out there these days. It's pretty amazing what one can do and get for free and access information. So, thank you for the byline. Yeah, I agree. Networking, it's very powerful. There's also a Friday Zoom session, No More Bad Zoom, they call it. A guy named Robbie Samuels out of Boston, a real talented guy. They do a free networking and Zoom training is what his specialty is. And he gets the word out that way. So it's pretty powerful. Networking is amazing stuff to be able to do. So food for thought. That's why we had a networking session at our last happy hour and training, as well as informational interview training. And now we're going to have more networking on April 15th when we have alumni come back. There'll be an alumni panel. There'll be networking breakout rooms to talk to alumni directly or ask questions to the panel about their careers and how they explored, how they grew, what they did. So that's the direction. Wanted to share those resources with you, make them available if you have an interest. All right, so let's go ahead and take a look at we're going to continue on fixed assets. And we're going to talk about the three kinds of depreciation. We broached it on Friday. We're going to reinforce it today. So plant assets, stuff you can touch, tangible, as opposed to intangibles, which we'll talk about next class. Actively used in the operations, expected to benefit future periods, and also known as PP&E, property, plant, and equipment. So this is a slide, this is information we know a little bit about. Everything is based on cost. We don't use fair market value. If you bought a building and paid $100,000 for it, great, that's a number I can hang my hat on. If 5 years from now it was in downtown New York, Chicago, or downtown Florence and it's worth $200,000, do you put it on the books for $200,000? Well, I'll tell you the answer is no. But why? Well, $200,000 is what one person's opinion is because I haven't sold it. Someone else might say it's worth $250. Someone else might say it's worth $150. So what do I put it on the books for? Which one? The lowest, the $150? The highest, $250? Or none of the above? And the choice is none of the above because historical cost is what I can hang my hat on. At the end of the depreciable life, maybe I said the car is going to last 5 years. The building may be 40. At the end of 40 years, the building has a $0 balance on my books. It's fully depreciated typically. It may have a residual value. We'll talk more about that in a minute. but it's not going to be what the market value. So the market value and the book value or net book value, NBV, we'll talk more about that, aren't going to be the same. Okay. After 5 years, my car probably isn't worth zero. So what goes into the cost? Purchase price, everything needed to prepare the asset to use it, and all acquisition costs to make it ready for use. Could be training, could be electrical, putting in a machine, could be customizing it, building out an area. All that goes into an asset, not expense. So let's look at machinery and equipment. We bought something, we paid sales tax on it, transportation charges, insurance, installing, assembling, and testing. Those are all costs. And the testing we can't expense in the current year. Do the same thing for buildings. Purchase of or construction, brokerage fees, attorney fees, taxes, title fees. By the way, property taxes are normally an expense after you buy a building. But if you are constructing a building, I built a $1.4 million building. I had to capitalize or make an asset the interest expense. You say, wait a minute, I get it. Interest expense is in the current year, net income on my income statement. Great, I can calculate it. When I built the building, my interest expense had to be capitalized, had to become part of the fixed asset, and I had to depreciate my interest expense during the construction phase. Then I took out a loan, I had a construction loan. Then I took out a loan, I financed the building, and that interest expense I could expense every year for operating the building. But during the construction phase, everything that went into construction had to be set up, and I had to worry about capitalizing it, making it a capital asset, making it equipment. We said land is never depreciated, but the things on the land can be. Parking lot might last 10 or 20 years. Fences might last 5 or 10. Walkways, lighting systems, shrubbery. When I built my building, I put in fruit trees. Yes, I had to depreciate those. I couldn't take a fruit tree, expense it in the year I put it in. Those had to be all part of the improvements to the land. You might have leasehold improvements. You lease a building and you customize the layout. You might have leasehold improvements that last for 5 or 10 years, the life of your lease. Again, we look at land, and you will recall, I've said it once and I'll say it again, land is not depreciated. Although if you're strip mining, surface mining land, you need to take in consideration deterioration or whatever you mine from it and the restoration costs to put it back when you're done with it, because you're not going to be able to leave it just in a strip mine state. That's part of when you buy land and you're doing things. Title insurance premiums, property taxes, again, during the time of acquiring the land, purchase price, surveying fees, real estate commissions, title search, which is what something does to verify that you're going to be able to keep it. Then afterwards, the land stays there. It does not depreciate. And the only time land will come off the balance sheet, I shouldn't have all them, 98% of the time is when you sell it. Now, there are some times maybe it gets flooded out and you have to impair the value of the land. It's now in a swamp or a marsh, or there's some issues with the land and you can't use it. Now you can write it off and reduce the value of the land. But that's not depreciating it. That's putting down the value, and you have an impairment on that land. So 98, 99%, the only time land goes away is when you sell it. Lump sum purchase. Okay. You buy land and building. The real estate tax rolls are very nice, actually, in the city. They separate the land from the improvements. So you'll see a dollar amount for the land and a dollar amount for the improvements. The improvements you can depreciate. The land you do not. So let's talk about some methods of depreciation. And we've got things like straight line. We've got things like units of production. And we have what we call the declining balance method. So let's look at how these work. So we've got straight line. We're going to look at our, I'm going to do a reshare here. I'll get that out there. Okay. So straight line, you've seen it before. So, man, let me clear that out. All right, so we have straight line depreciation. We get a purchase price. We also have a salvage value. And we get a net depreciable value. So let's think about that. Maybe we have a purchase price of $120,000. And we have a salvage value of $20,000. We have a net depreciable value of $100,000. Okay. So then we take our purchase price minus salvage value. And we said that was equal to the net depreciable value. Just put the acronym there. And so now we got $100,000. Then we have life, useful life. Let's say we say 5 years. So what do? We take our $100,000 divided by 5 years. Again, we're looking for dollars per year. And we're going to come up with $5,000. I'm sorry, you can do the math. $20,000 per year. Okay. So what's going to happen? We're going to have our balance sheet and our income statement. And we're going to have our, well, I'll call this fixed asset vehicle. It's a truck. And then we're going to have accumulated depreciation vehicle. And then we're going to have down here depreciation expense. So if I look at this, I'm going to come up with a journal entry of $5,000. So why do I keep doing that? $20,000 and $20,000. Do I debit the expense or credit the expense? I'll look at this picture. My expense is here on the left. I'm going to debit that. So I'm going to put in my depreciation expense. And I'm crediting a contra asset. Notice my vehicle will be sitting at 120. My accumulated depreciation is going to be 20,000 a year. I got to credit my accumulated depreciation. So I'm going to call it accumulated depreciation vehicle, $20,000. So that will be my entry every year for the next 5 years. And what's going to happen? I'm going to start out with $120,000. And after the first year, I'm going to take away 20,000. In the second year, I'll have 40,000. Third, you'll have 60. I'll get up to 100 by my fifth year. And my net book value is going to be my salvage value. It's never going to go below that 20,000 unless I need to make an adjustment. And every year, my depreciation expense is 20K. That goes to 0 next year. And then it starts again, 20K, 0, 20K, 0, on and on. Does that make sense so far? Let's clear that out a little bit, erase that up, clean that up. Okay. All right. So that's our straight line. So let's go back and walk through our straight line operations and see what that looks like. I'm going to share again and do the advanced. Go to the portion of screen. All right. So nothing fancy. Calculate cost, salvage value, useful life. This is a $10,000 asset with a $1,000 depreciable cost, salvage value for $9,000 depreciable cost over 5 years. Okay. And what do? We get $1,800 a year. And every year we're going to make that entry. So what's happening here? Our depreciation expense each year is $1,800. But if I look at my book value, I start at the $100,000 mark. Year-end book value starts at, I'm sorry, 10,000. After $1,800, after net book value, take away 1,800 accumulated depreciation is 82. Take away 3,600 next year is 64, down to 46. And finally gets down to the 1,000 salvage value. So hopefully that makes sense as you read through that, as you make sense of that. And again, this is $1,800 a year. Our accumulated depreciation increases every year, and our NBV, our net book value, is down to $1,000 when all is said and done. So let's look at units of production method. Units of production is one extra step. We got to go in and calculate the units. So I'm going to go through an example of that truck that we had. And we're going to go in and we're going to do, instead of straight line, I'm going to go ahead and I'm still going to have a truck to the tune of $100,000 straight line depreciation. We've got 120,000 purchase price. Oops, let's get that lined up here. 120. We have a salvage value of 20K. And we have a net depreciable value of 100,000. But instead of going through and saying, let's do this based on 5 years, let's do, you know about a tractor trailer. The tractor is not a farm tractor, but the tractor is the truck at the front. That's the 10 wheels. And the trailer in the back has the 8 wheels, the 2 doubles, the 4 on each side. So we have it's called an 18-wheeler for that reason, because usually typically it's an 18-wheeled vehicle, 10 wheels on the tractor, 8 wheels on the trailer. So we just bought a tractor for 120 grand. So average value 20 grand, life of 5 years. And we estimate 1 million miles estimated life. So if I have $120,000, I'm looking for dollars per mile. So if I take $120,000 divided by, I'm sorry, we have net. So I net depreciable value is $100,000 and divide that by 1 million miles. According to my calculations, I come up with 10 cents a mile. So 10 cents per mile. If I drive 500,000 miles, 500,000 miles, that's $50,000. If I drive 10,000, say 100,000 miles times 10 cents a mile, that's going to equal $10,000. So you say, wait a minute, I drove 100,000 miles, the life is $1 million, that's about 10%. And coincidentally, $10,000 is 10% of $100,000. So that's how we do on a per mile or units of measure form. So I'm going to go back here. Oops, I went back too far. Let's go back to our whiteboard. Oops. I'm going to go back here. Thank you for your patience. All right, so now we go back and we look at how the units of measure does. Two-step process. We calculate the dollars per unit. This case is 25 cents, I think, per pair of shoes. We did shoes. I suspect it's pairs. 7,000 units were inspected during the year. Depreciation would be calculated as follows: 25 cents a unit times 7,000 units is $1,750. There's our depreciation schedule. And we're on our way. Now let's talk about the declining balance method. This is probably the most confusing of all. So let's go ahead and take a look at our, with the declining balance method, okay, do not use salvage value initially. Okay. And for sake of ease, I'm going to say I bought a truck for $100,000. I'm going to put a salvage value, 10,000. But and declining balance is based on the net book value. Also, which is also known as the asset minus accumulated depreciation. So let's see how that works here. So now we're going to start with double declining balance. So if we had a 5-year asset, straight line is 1/5 per year, or 20%. Double declining balance is going to be 40%. So how do I do this? My first year depreciation, I take my $100,000 minus accumulated depreciation of 0, and I multiply that times 40%. And I'm going to get $40,000 in my first year. My second year, I'm going to take $100,000 minus my $40,000 and multiply that by 40%. And I'm going to come up with 60 times 0.4. I'm going to get $24,000. Third year, I'm going to do the same thing, $100,000, but this time I have $64,000 accumulated depreciation, my 40 and my 24. Multiplied times 0.4. And I'm going to have 36. I'm going to have 14.4K. I'm an accountant. I can do the math in my head, but you would use a calculator. That's fine. The catch is, though, never go below net book value of $10,000. Because that's where you use the salvage value. But we're not taking the salvage value out of our calculation. And you might have triple declining balance. You might have 150% declining balance instead of double. That would make this 30%. We might have triple declining balance. That would make it 60%. And the reason we talk about this is because this is what the IRS likes to use. Okay. So the IRS has something called MAKERS, which is Modified Accelerated Cost Recovery System. So MAKERS, what the IRS uses, and most small business will do whatever the IRS does just to keep your books, but you can have multiple sets of books. And they use something called a mid-year convention. What's a mid-year convention? We're going to see in the next class, when we talk about buying an asset on 7/1 and using it to 12/31, you're saying, oh, that's 6 months of depreciation. That's a half year. If I buy it in January 31, I need 11 months. If I buy it December 1, I get 1 month. But a mid-year convention says it doesn't matter when you buy it, you take a half year in the first year. So we're going to talk more about that next class, and we're going to talk about the timing on how that fits together. So on that note, I'm going to stop the share, ask any questions you might have, and then wish you a good week. Any comments or questions? Then I wish you well. Happy Monday. Have a good week.
You too.
Thank you. Appreciate it, Tonio.
Have a good week.
You too, Alexis.